Okay, let's move right on and get on board Mr. Sunil Subramaniam, who's joining us to talk a bit more about the markets, the various themes you need to look out for. Mr. Subramaniam, good to have you back on the show once again. Want to understand, there's lots of developments happening on the corporate front, micros, various sectors, various companies that have been in the focus. There's election season which has kick-started as well. Over and above that, there's also on the macro front, there's been a lot of moves when it comes to crude oil, when it comes to base metals, when it comes to gold. So lots has been happening. Talk to us about the uncertainty and the volatility that comes with it, and how are you playing or rather riding on this wave of uncertainty and of so much jitteriness ahead of elections, ahead of the earnings season as well?
I agree that there is a lot of uncertainty overhang on the markets, right? And so as a mutual fund manager, our main focus, I think, is essentially, if you look at it, the good part of being a mutual fund manager is that we can always take a 3 to 5 year outlook in terms of what we buy. So we don't need to really go with the waves in the market that's happening. So in a sense, what we have tried to do is to seek, and if I may use the hot word of the moment, choose election-proof kind of sectors to allocate to. And there are 3 key sectors that we have identified, we were consistently allocating over the last few months and will continue to do so. The first and foremost is consumption. Now within consumption there are a lot of nuances, right? So there's FMCG, there's high-end consumer durables, and there is low-end consumer discretionary. So the low-end consumer discretionary, where a rising middle class, and that's where even though GDP growth rate numbers may come from 7.5 to 7.1, the fact is 7 itself is a very solid growth rate which generates a lot of demand in terms of incomes in the economy. So we believe consumption with a specific focus on the low-end discretionary is a ongoing theme which should really play out well over the next 3 to 5 years. So that's something we have been allocating to. The second aspect is that this 7% GDP growth rate has been there for over 2 to 3 years now consistently. So in tracking the underlying consumption sectors, we find that there are a lot of sectors which are in excess of 80-85% in capacity utilization. So as over the next 6 months we see them come close to 90%, we really expect that the cap goods cycle is going to get a kickstart with the private sector actually coming in and taking their next 3-year plans and starting to invest in capex. So what they are doing is not for 2020 but for 2022. Right? So the capital goods cycle, so we, in studying the last time the capex cycle happened around 2013, take the same kind of sectors and stocks which then did it, look at the capacity utilization of these sectors and where they are likely to do order books, and are beginning now to allocate to cyclicals, EPC contractors, building materials and metals which are linked to the economic cycle. So I would say steel, in a way, ferrous, non-ferrous metals like aluminum, copper. So these are the things we believe the demand is going to consistently go up, and that cyclical element will come in. Now both with the short-term consumption view and a longer-term cyclical view, the biggest beneficiary of both of these is going to be the banking sector. Right, so whether it's the fact the absence of NBFCs means that private sector banks are going to be able to lend to retail consumers much more comfortably without competition, and when the capex cycle recovers, the corporate banks are going to recover. So private sector still is a preferred banking channel for us compared to the public sector. The only reason for that, though the valuations of public sector still looks very attractive, is that we would rather prefer those public sector banks which have been through the merger cycle. Otherwise the risk of a good bank being merged with a bad bank, and so the resultant bank being neither good nor bad, is a risk that we don't want to run too much on the public sector space. So in public sector we are very specifically selecting those where there is no threat of a merger likely to happen. But in the private sector, good quality banks which have seen the NPA cycle through are definitely among our top picks. So to summarize, I think consumption, the cyclical cap goods story, as well as the banking sector are those which I would consider the uncertainty proof in the shorter term scenario, and hence in another thing you probably didn't mention, the uncertainty comes because of the earnings season. The earnings season is very vital this time because it's not the last quarter's earnings or the full year earnings of last year, but the guidance that they give for the next year, which is going to help out. So we are very eagerly and keenly watching that to decide on our fresh picks on which stocks to buy within these sectors.
Hi Sunil, Nantara here from New Delhi. Good afternoon. Thanks for taking us through some of the sectors, but I want to get down to specifics now. IT is a flavor of the day. I don't think Sunil can hear me. Karanya, over to you.
Let me just take the question for you. Sunil, what Nayantara was essentially trying to understand is IT clearly has been the flavor of this, entire time, and today with the tech giants kick-starting the earnings season for us, and how do you think the sector is poised to deliver when it comes to earnings growth, and from a slightly medium to longer term perspective also, if you could share with us what is your view on this space?
Okay, so I think the IT earnings results will be fairly good because they have going to show the impact of the dollar strengthening as well as the demand that they had seen. But if you look at from a next 2 to 3 year outlook, we believe that it's going to be a more stable industry rather than a growth industry. We believe it's more a part of a defensive safety play for 2 reasons here. One is we expect that with the fiscal troubles of the US, right, that the dollar is going to be under pressure. Hence, the rupee is not going to be under pressure. Second, we believe crude will stabilize around the $70 to $75 mark, and it's another reason why the rupee will not weaken very significantly. So, one of the strong headwinds, favorable headwinds, which the IT was benefiting from in the earlier 2 years, is not going to be present. Second is the world economies, all the growth rates are being downsized. So, in that context, how the IT companies demand for their products. Some sectors in a downtrend they tend to outsource more to get the economies of scale and efficiencies. But some other sectors, because they don't see growth, they actually tile down their IT. That's the second aspect. The third aspect is the challenges around the visa set of regime on the H1B from the US and other countries. So we believe that there are a fair amount of headwinds on both sides on the IT. So, but at the same time, it's not going to disappoint or go through a downtrend. So we believe that it's a key component of every portfolio, and we would keep it in the portfolio, but more as a safety come defensive play. That's the way we would look at the IT sector.
Okay, and overall, how are you assessing the entire situation with respect to liquidity, with respect to, how NBFCs were really struggling, financiers for CVs, for housing companies and real estate sectors were also under a fair amount of pressure when it comes to the liquidity situation. How are you assessing that? Have those concerns eased at all?
We think that there has been strong improvement on the NBFC space in terms of this, in the sense that now the good quality NBFCs are able to raise funding at reasonable pricing. That's a big change over the last 2-3 months that we see. While the overall NBFC system continues to suffer pressure, fresh lending is not happening from the NBFCs. I think those NBFCs with good corporate governance, a good strong ownership of the parent and that comfort to the market are coming back to even to mutual funds on the debt side to raise money. They are able to tap the medium term money and they are able to raise securitized money from the banks. So we believe that, so we have in fact changed from an underweight status to neutral on the NBFC space and are picking good quality NBFCs because we believe that with the consumption boom, they do have a part to play because a bank cannot reach to the extent an NBFC can be reached, reach to the lower income class.
All right, Sunil, great chatting with you as always. Thank you so much for coming on board and sharing with us your well-rounded perspective on the markets, given the various scenarios and the various themes that are playing out parallelly, and also sharing with us your top picks when it comes to sectoral ideas. Thank you so much.
Thank you.